Hi, everyone. Welcome to the TimingResearch.com crowd forecast news for July 5th, 2022. We are recording this at about 4:15 p.m. Eastern Time, and this is episode number 349. My name is David Kosmeter. I'm the creator of TimingResearch.com, and today I've arranged for Michael Filighera to be here to do a solo market outlook episode for us. And I'm going to go ahead and turn it over to him.
And thank you, David. And first, let me say I am so sorry for my tardiness, but sometimes, hi Lonnie, sometimes the best laid plans, right? I kind of had in my mind that I was going to sneak away and go to the gym, and then suddenly I got a phone call. It's like, hey, you're logging in. So I apologize. I apologize for that. But lots to talk about today. I will start with the S&P since that seems to be the focus of these meetings. And what is really coming about with the S&P is going to be the big question. Will the S&P close higher than where it opened today? So if we just take a peek, I'm going to go up to the daily so I can get it accurate. We opened today at 38.28. We're finishing up around 38.31. So we're already higher than the opening. And we got as high as 57. So to answer that question as to will the Pirates beat the Yankees tonight? I don't really follow that side of baseball. That's too far east for me. I'm on the West Coast. And if it was the Pirates versus the Giants, I would say, yes, the Pirates are going to win. But the Yankees, I'm not sure. Sorry. In any case, what we've really been dealing with during this whole period is, again, how the markets tend to relate and agree or disagree with inflation, with interest rates going higher, with all sorts of things that seem to be still, to me, somewhere halfway in the denial camp and halfway in the how could it possibly happen camp. And I think that that's not necessarily a great place to be, but putting it together with what I think is going on here in the market. Those that have heard me before know that I use Elliott Wave. And in fact, I have been using Elliott Wave and studying it and using it for over 35 years. So my teachers were Robert Prechter and Dan Ascani back in the 80s, eons ago, let's say. And I started to use it very consistently shortly after I picked up all the tools of the trade, so to speak. And Elliott, oh, sorry about that. It's not so hard. What can be difficult about Elliott is that it's really on the basis of building blocks. And what building blocks really do is they're measuring human emotional reactions. Elliott Wave does not really stand out and say that it takes into consideration fundamentals, any geopolitical situations, political situations, interest rates, et cetera, et cetera, et cetera. It does not take anything like that into view, but because how can we, in terms of when you're trying to forecast when rates are going to go up? Who's going to know? So what it does do is it measures the emotional reactions that we as human beings tend to put in to our markets. And that is a trackable, chartable way to keep an eye on where things are. Now, having said that, what I believe that the markets have done so far, now this is looking at a daily chart, so I'm looking at a little bit larger picture. The S&P, in my opinion, topped back in January. In fact, on January the 4th, and it topped at 48.08. And from that level, we began a very large, longer term corrective phase. And if you have any understanding of Elliott, being that it's building blocks and the degrees come into play, this particular high completed an intermediate degree 5-wave advance, a primary degree 5-wave advance, a cycle degree 5-wave advance, and then, of course, a larger supercycle degree 3rd wave advance. Now, just to give you in terms of time, this 3rd wave in the S&P began in 1932. So 90 years it's taken to get up to this point, and within it, there have been several crashes, one depression, lots of recessions, war, several, all kinds of things have all taken into place in here. And each one along the way has been a corrective phase. And so what we're now confronting is another corrective phase. And what I need to do now is work it back down to figure out how all of this is going to unfold. The first thing on the line is that I'm now going to be tracing out, as the market traces it out, an ABC degree, intermediate degree decline. So what we have is the A wave, the B wave, and a C wave, which is still in progress, by the way. Now, having a little understanding of Elliott, we all know that in Elliott, a C wave always will come out as 5 waves, and they subdivide and they grow and they, continue to just move along as the market moves along. So without having a deep understanding, my belief here in what the S&P is doing is of course reacting to higher inflation, to interest rates needing to be adjusted, to the market needing to adjust to what we continue to try to achieve. And that is moving back to a state of, and I'm putting quotes around this, normal. Now, having again said that, I think it's very interesting and it becomes very important for us as traders to, and actually just as people who live in the United States, that it's virtually impossible to go back to what we want to consider normal prior to the pandemic. And the pandemic has basically shattered a lot of things. One that I find to be very important to understand and to also agree with would be that the pandemic shattered the status quo. And what I mean by status quo is this is the way it's always been. This is the way it always happens. This is what usually takes place in our markets, in my life, with interest rates, with all of the different things that we're going through. Unfortunately, it's not possible because we're just now figuring out what truly the pandemic has done to our economies, local, state, Fed, all across the board. What has it done to our earnings power? What has it done to all the different things that go into what produces and keeps a bull market going, or what produces and forces a bear market to unfold? So what we went through, and I'm just going to go up to my weekly chart and I'll show you on this level, here was the pandemic slide that we did in March of 2020. We got all the way down here at the bottom and we realized that we went into nationwide lockdown. Everybody had to stay home. We were limited as to where we could go. We had no idea how quickly or how severely the COVID was going to spread. We had no concept of the amount of people that would succumb to this virus. So there were a lot of factors that just really produced this move, the biggest of which was fear. Now, what happened when we got to that bottom was that the government realized that if we're going to be in lockdown and we want to have any chance at a recovery coming out of this, they needed to start coming up with the means in which to subsidize or get all of us money in our bank accounts, in our pockets, so that we then could turn and buy groceries. We could turn, pay our mortgages, pay our rent, pay our bills, and keep the economy going. Failure to do that would have shut everything down, and we would not have stopped with the S&P, I believe, dropped 38% here, lost 38% of its value in 3 weeks. It would not have stopped there at all. We would still be falling because we're still dealing with the fallout of being in lockdown for 2 years. Now, whether we want to accept that or not does not suggest by any means that it's not happening, nor will it continue to happen. So one of the things that I find is that we had then trillions, and we know that to be true because we were all here, trillions of dollars being printed and injected back into the system via economic impact payments, via low interest rate loans to corporate, via the Fed dropping interest rates to less than 1%. So we blast because every corporation stood at the front of that line to go grab this cheap money. Now, the whole concept is that by them getting all of that money, they would be able to continue to pay their employees, which would continue to keep the economy going because everyone still had to pay their rent, pay their mortgages, pay their insurance, et cetera, et cetera, et cetera. So that was the case. We come to find out a little bit later that no, a lot of that went into the corporate pocket and not necessarily got turned back out. And so more was given. Interest rates just continued to drop pretty much right up. Interest rates, I believe, the yields bottomed, the bond prices topped somewhere around August, between August and November of 21. So I'm still back here. So this has to go way back. So in any case, this is going to be, it's not 22 because I'm telling you that's January. Yes. So we're back into here and August. Here we are right into here. About here is where interest rates topped. But it takes a while for the market to actually grab a hold of that and believe it because they hadn't started to tick higher yet. So, but they did top, and the bonds themselves started to give us a little bit of a reaction. Now, let's continue to put this picture together. So here we are that we've got bond yields bottoming, bond prices topping. So it's the same thing we had here. We have the equity markets topping, finishing, and needing to correct. And yet we have so many players and people who just don't see the necessity for this to happen, or they don't see why it needs to happen. Well, let me try to just put something into perspective here, because this is the long way to my answer that the S&P, in my opinion, will close lower than where it opened today. And so just to continue, when I design or I look at a pecking order or the food chain or however you want to term it, what I put at the absolute top of all of that are interest rates. And interest rates dictate everything. They dictate what I have to pay to borrow money and what I will get when I lend it out. Therefore, everything else down below, when there's an adjustment to those interest rates, needs to make their own adjustment. So here you have interest rates at the top, then below it, we have the currency, we have bond market, then we have equities and other markets that rely on money. And eventually it starts to filter down, going through all of the sectors. Now, we've already heard from several. For example, Amazon last quarter, so not necessarily the second quarter, which is just complete, so we're going to be waiting to see what their earnings are like, but in March, so after the first quarter earnings report, Amazon, after reporting quarter after quarter after quarter of 50, 60, 70 billion dollar profits that they were actually making because of a lot of it, because of the pandemic, because we all had to have everything delivered to us. Well, that was a boon for a company like Amazon because they got it to us quick, they got it efficient, and they skyrocketed. But did anybody really pay attention that last quarter earnings report, the first quarter earnings, Amazon reported a nearly $7 billion loss? And it was due to increased cost. It was due to inflation. Now, this is something else that people just don't care to accept, but you can't deny it. You can't escape it. We all will feel it. It will knock on our door. We're now seeing it, gasoline prices. And I don't know if I'm the only one here today that lives on the West Coast or lives in the state of California, but I live in San Francisco. And the cheap gas is well above $6. So we pay around $6.50 and up. There are other parts of California where it's as high as $9 or $10. And I'm not joking, but those are kind of the remote, off the beaten path little towns. Now, there's that. So one of the things that we're talking about when we're looking at the consumer price index is for years, they decided, well, we don't need to include food and energy. And it's like, really? Well, right now, food and energy are a big part of everybody's monthly expenses. So here we are paying double to triple what it cost us to fill the tank just a short few months ago. Then we get to get in our car that's costing us triple to fill it, go to the grocery store, and that's now costing us twice as much as it did 3 months ago. So as inflation filters down through, as these supply chain problems filter down through, as the fact that we have a geopolitical situation going on in the Ukraine, where one country's invaded the other to decide they're going to take it back and mercilessly are just destroying all infrastructure. Let me just say, the Ukraine is, I'm not sure how high, if it's not number one, it's like number two, exporter of wheat and other grains. So nothing has been able to get out of the Ukraine in the terms of grains, wheat, etc. What does that do? Well, it forces up the prices where wheat is available everywhere else. Well, then what happens? Producers, they feel it first. So the producer price index is going to start climbing due to inflation. But guess what? They then pass that on right away to us as the consumer because they still need to make money. Now, add on to this that as this inflation comes into play, that now we're going to have wage inflation. We have to. The people we work for, and if you're retired, the government has got to be able to dole out more money because it's costing us as the citizens, as the people who are working, more money to live. So it's a vicious game that will continue to filter down through all of the systems. There will be repricing all the way down. We cannot ignore it. So based on that, as this repricing goes, I believe that the market, and I'm going to give you the monthly max, the market is going to be correcting from that 2009 low all the way up to that high in 2022. That's what we're correcting. Now, when I take a look at Elliott, because these are the cycle waves, the super cycle wave, I need to go back out and put it up on the SPX so that I can show you the depth. Here is super cycle wave 2. Here is super cycle wave 3. Now, does it make any sense for me to tell you that, well, we're correcting the last 90 years? No. I don't know about you, but I'm 68 years old. If I had to think that, well, this could take 30 years to correct, I don't know if I'll be trading. Quite frankly, I wouldn't care. I will be 98 years old? No. So it doesn't make sense to go into that great a detail. But what I can say from that level is that what the market tends to do is, if we're looking for a super cycle fourth wave, when you study Elliott, one thing that Elliott observed and notated was that the fourth wave, when we're in a fourth wave correction, it most often will find its terminus or its endpoint within the price action down to the terminus of the fourth wave of one lesser degree. Well, we have super cycle, one lesser degree is cycle. Where is that low? Well, it's a number that I'm going to round up and call 667. Now, that's just the first point that I can put out. But as this unfolds, this gets adjusted. Now, so what we're going to be looking at here in terms of this correction is that we're going to first get an ABC of intermediate degree. That'll form the A wave of the primary degree. Then we'll do a primary B and a primary C wave, and that will form the A wave of the cycle degree. Then we'll get a cycle wave B and a cycle wave C, and that will form the super cycle fourth wave. So, and I estimate that if it took basically quite a bit of time, even if I go out to my max chart and I go to here and I go to 2009, and I think, well, at least it should be correcting the last 13 years. The last 13 years of rally needs to be corrected. That's why I continue to use that number, but I actually don't think that we get all the way down there, but we can. But I will monitor as it goes along. Now, back again, I make updates, video updates every day. And one is in the NASDAQ and the other is in the S&P. And that's more or less the daily activity. But I do often, at least once a quarter, do a big picture update. And those I've just posted. And I will try to, in fact, I'll put it in right now into the chat box in case there's anybody who may want to see it. If you went onto YouTube and you looked for Traders Helping Traders, and then make sure that you find my name and the channel you want. I have 11,800, and I think I'm almost up to 75 subscribers. And that's the one you're going to want to go check out, and you're going to want to subscribe to. Now, once you do, you'll be able to find all of my recordings and all of my updates. And in the latest big picture update, I began to discuss what I felt we're up against right now in the S&P just to get this intermediate degree ABC done. So I think that we're falling within a minor third wave, regardless of what this little puppy did today, and particularly in the NASDAQ, and they're still pushing against the NASDAQ. Why? Well, because everybody else is buying Apple and Amazon and Google and Facebook and Microsoft, et cetera, et cetera, et cetera. Well, they're buying. What do they know? I don't know. And let's all go. And they all come in. And so it doesn't take much to really get this table to turn, because I think that there's so many people that are just absolutely hanging on by a thread. They haven't gotten out of any positions, or they're waiting for this opportunity to buy because, oh, it's all got to be over soon, right? No, it doesn't. So don't fall into a trap. Now, markets don't just drop. Sometimes they do, and it's a crash, but you can see it doesn't go forever. It stops and they rebound. So if this indeed, right now we're still in a position where the S&P can really decide that it's going to move up one more time and get itself back above 4,000. Now that'll really pull in everybody who's like sitting on the fence. Are we bullish? Are we bearish? Well, look, we're back above 4,000. That's got to mean something. Everything's great. And it won't be. So while I consider to think that the market should continue lower, and I'll leave it, my forecast for the end of the week there, there's also an equal chance that it won't. So I have to always give it a 50-50 probability here. If it doesn't, then what's going on is that we did an A, a B, and we're doing a C, and that is to complete a minor wave 2. See, the impulse waves, the 1, 3, and the 5, they break into their own 5-wave structures. The corrective waves are A, B, C, of which we sit in. It takes a lot longer to do that corrective wave than it does to do the drop. So here we sit. We're still in it. We're still futzing around. And you can see we started pretty well today. We started, they sold it off. They got it down to the low that we saw on Friday. And then just said, no. And then they bought it and they continued to buy for the balance of the day. They're still buying it now. In fact, now they've got the S&P higher. The Dow's the only one that's not higher. They got the Russell higher. They got the NASDAQ higher. And you're going to find a ton of reasons why. Oh, we're buying because look, crude oil dropped below $100. Oh, inflation's over. Pile back in. Whatever they want to say. Don't be surprised if crude oil goes up $10 tomorrow. It can. So I say all of this basically to give what I think that bigger picture is, that even if this goes back, if the S&P goes back to 39.96 or up to 4,000, I do not believe that the market will just continue to go up. And I'll tell you the primary reason is, and this is what I encourage everyone to do. Is inflation tamed? Is it turning on its tail and lessening anything? Crude oil being down $8 is not telling me much. Yes, it's a good start, but it's not telling me that the price of gas in the state of California is going to drop 10 or 15 or 20 cents. It's going to get itself back below $6 a gallon. That I don't see coming up anytime soon. So again, be careful about how you want to interpret things. So what I ask myself, has inflation been tamed? Are interest rates really done going up? Can we really assume that we started basically below 1%, and because we are at 3 to 4, maybe 5% on mortgages, and I think the 10-year note might be close to 4% now? I know I got reports today, and the 26-week T-bill was closer to 3%. It was over 2%, and the 13-week was close to. Actually, I can tell you that. Hold on one second while I zip over and get that. That interest rates continue to climb, and what the government is deciding to pay is reflecting that. The government needs dollars. So what does that tell us? Well, they've got to go out and get it somewhere, right? Now, the 26-week auction produced 2.567. 2.567%. The government, the Treasury is paying for a 26-week T-bill. On the 13-week T-bill, this is of today. These were the auctions. It's 1.885%. Now, guaranteed, I'm telling you, just a short month or two ago, these were less than 1%. The 13-week T-bill was less than 1%. It was like maybe 0.75%, maybe 0.5%, 0.5%. This is how quick we're going up. I wouldn't be jumping up and down if this is what came out. The issues for tomorrow, or actually on Wednesday, they will be issued Wednesday. So this is the issue date of 7/7. Rates are up yet again. Oh, well, everything is okay because crude went down $8. Don't be fooled. Don't be lulled into this sense of relief. It's very short-lived. Whether this goes up all the way to 4,000 or not, the next leg should rip it to shreds. That's in my opinion. Now, the only other way I can count this is this 5 waves down did complete this intermediate degree C wave, and I get to put a primary A wave underneath that, and that would suggest that we're going to do a primary B wave advance. Now, this is off to a nice start. It certainly is, but I would expect that today's activity under a thin market, under low volume, let's just double check. Where did we get to? Not bad on the S&P. On the NASDAQ, it should be 1 million here, not on the micro, but in the mini contract. And this encompasses Sunday's Globex, Monday's Globex, and today's session. So basically, we have 2 Globex sessions. We go around the globe, and today's US session, and we only ended up with 783. And when we walked in today, it was already at 400 some odd thousand, just from the 2 Globex sessions. So our volume's low by low, and look at how far they can push it. So all things considered, we are still in some serious problems. And yes, I believe that the governments and that other areas and other people are working diligently on resolving problems and coming up with solutions and putting those solutions into place. The biggest one being, what's happening in the Ukraine. That continues to really plague the globe, not just the Ukraine. There's a lot of disruptions to a lot of different areas that are coming out of that. And so when this all comes back together, then I think that we're likely just going to be in this intervening larger B wave. Now, it might be on a cycle degree, it might be on the primary degree, but then we'll get a more sustainable rally. But I don't think we're there yet. I don't think that we're close to that point. I think we get a little bit up, then we kind of come down. And I think that we might get the B wave somewhere down in here. So I actually, my original forecast for the S&P was that we would come down to the A wave, the primary degree A wave would finish up somewhere down around in here, somewhere within this price range. And up the top, we have 3380 up in there, down to 2200, I'll call it. And that's why I think this comes in. And then we get a sustainable several months of a big rally. And I'm sure there could be a lot of reasons why they think why it'll happen. But read up on what a B wave consists of and what really goes on and how it happens. So, long story short, do I think that the S&P will close higher on Friday than it opened today? There's a 50% probability that it will, but it'll be a head fake. in my opinion, because what comes next is a stronger, more severe downside move. And what's going to be a part of that? Well, let's see what we got coming out. Tomorrow, we've got PMI composite, no big deal. We got the FOMC minutes, but I tell you, they're probably going to buy the market based on that because it's just the minutes of everything we already know. This is the minutes from the last meeting. We already know what they did. So, and we loved it then. So maybe they'll put it out and they'll love it again, which will help us to get back to that 4,000 level, by the way. But then what do we have? We have international trades in goods and services. We have jobless claims. And the long-awaited EIA petroleum report. That'll come out. Well, let's see what crude wants to do when that happens. And then we have another major report on Friday, and that is our employment situation for the month of June. What that shows, now please remember, full employment is not bullish. More people going back to work, it does ease the burden of our government's paying out versus taking in, because more people working, more tax revenue. So we get all that. But right now, having full employment is not bullish. It puts a lot of wage inflation on corporate, on companies. So one way or the other, it's like, what do we want? But we're in a situation globally, or at least nationally, where all of this needs to filter through. All of this needs to really be done carefully. Overdoing one to the other is not healthy. We've gone too far. We overextended to the upside. Much of it, in my belief, was done on air, was done on interest rates will never go up. So as long as we have these low interest rates, companies will still be able to, build their employees base. Now, back to that statement, which is where I started all of this. If we think about this, our latest was good old Mark Zuckerberg. Mr. Zuckerberg did come out and he started to lay down the law and that we're not probably going to fulfill our hiring quotas and adding all these engineers and all these different people because, boy, we're growing. Inflation's finally come and knocked on Metaverse's door, just like it knocked on Amazon's door. I'm waiting to hear what Apple wants to tell me. But I knew that just from what I could see, I'm going to show you another little secret thing that I do. When you want to really take a peek at what these, of what these big major firms, let's consider the following. We have many, many, many high frequency trading firms. We need them because A, they provide volatility, and B, they provide a lot of volume, and we need both to keep our market healthy and to keep day traders like me trading. But they don't care if the market goes up or down. Their algorithms are set to take advantage of premium. When they're trading the options, it's premium. And if I looked at this, here we have coming in today for these options that expire on Friday, it was the 140 strike. So they had dealt with all this last week, and now we had the 140 strike. Well, when they started to buy it, see, it opened at 136, 137. They popped it immediately, or they got it above 137. They popped it immediately above 138, and I knew right then and there they were not going to stop until they got it to 140. They did. They pulled back a little bit, but then they kept going. Kept going, kept going, kept going. Okay, that's what we do. So I always kind of check to see what they're trading. Everybody's running after this, but it's a premium play. So they're not buying this and thinking you're going to carry it. And for, or they're selling this call and buying the underlying. And because if they've done that, it's a done deal. They sold the call, they bought the stock, they will sell it to somebody at 142 or whatever the price was equivalent to. And so they get and it's a hedge trade, it's done. So when we're seeing these large numbers, they don't necessarily get moved over and show you a increase in open interest. That tells you how many high frequency firms are coming in, trading, and are done. And that can produce a false sense of they're bullish on Apple. They're bullish on Google. Google splits 20-for-1 on July the 15th. That was a big part of why they're buying that today. Metaverse, couldn't tell you why somebody thought it was a good idea to take that up $9 or $10 today, but they did. Because they're like, oh, we're okay. Mark Zuckerberg got everything in control. Or they just felt that the stock was undervalued and they're going to go recommend it and move into it. Microsoft, it's all options. And actually what they did come in today was that they came in on the FANG stocks, Facebook, AKA Metaverse, Amazon, Netflix, Google, and don't forget the one that they tucked into the end of that, and that's Uber. See Uber today? Uber, which can't make a dime, up $1.18. They're suffering greatly because they can't collect enough from their riders to help pay the drivers for the gas that they're putting in their cars. So there's less drivers. So they're not getting the rides that they think they're going to get. And so it's a constantly churning, changing thing. And here we are stepping into a market. So let me just wrap this up as best I can, because what I want to now share with you is how I approach the market. I approach the market without a bias. And what I mean by that, I'm not biased to the upside or to the downside. I'm not bullish. I'm not bearish. I follow price action. So what does that mean? I have become a day trader. I come in every day clean. I don't have a position. I'm not looking to buy a stock because I think the economy is doing great. I'm not looking to sell a stock because I think that the economy is doing poorly. Whatever happens in any of the 100 components or the 500 in the S&P, 100 in the NASDAQ, whatever happens is going to be visible to me in the price action. So I play price action. In fact, I can tell you, I can do it here easier. I can show you, but I'm playing price action right here. And I've used the moving averages. And the moving averages catch everything. And there are specific, they're not necessarily rules, but when they start to break, like my update last night was very conclusive that the moving averages were all bunched together down at the bottom of where the charts were. Let me go, not a 1 minute, that's a little bit too short. Sorry, going too fast. I want to take a look at this 5 minutes. So here we are. Here's our opening. Here was where we came up yesterday when I was making my no, actually, I have to go all the way back. They were all here, and I thought if it breaks, we've got to follow, which it did. That was yesterday's Globex. So you can see the moving averages together, but once they broke, they all got into alignment to go up. And that is because this is a 200, that's a 50, that's a 20, that's the 8, that's the 4. When they're all in alignment, so lowest at the top, longest at the bottom, boom, they're going up. And it came in, and then they started to collapse over here. Then they were in alignment to go down. Boom, 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 and tumble we did. Then we got back over here, right here. All right, we got this big opening. They slid back down. Now what are they going to do? See what they did? They came in and they broke the 20 and they didn't stop. Then they broke the 50 and they kind of stopped, but then it kept going. And here they broke the 50 and then it just went. And when they broke the back above the 200, it accelerated. Right? This is the EMA. This is the SMA. it accelerated and it continued right on up. Now, what can they do tomorrow? Tell you the truth, I give you both sides of the coin. They could continue to take it higher. It definitely has the room. And if it starts to break down, it's going to be the same stories. They start breaking below these moving averages. You look for it to start to accelerate. Right here, these two are coming in right on each other. It's just not healthy. And how they do it is not healthy, but you know, they don't call us. They just kind of go and do. So it's a wall of worry. And so right now, these are all lined up to go up and continue to go up. That's a 5-minute chart. I'll be pulling it out and looking at my daily chart to see. In any case, I'm kind of going over. Again, I apologize for my delay today. I thank you for listening. There's so much more to say. I encourage everybody, please come and check me out on YouTube, subscribe. That way, anytime I make a new update, you will get notification and you can come in and listen if you'd like. And if not, that's okay too. But at least you'll be kept up on what I think is truly happening in a non-biased way. I find that it's much easier to approach the market without a bullish or bearish bias. That way we're open to whatever the price action, whatever the market is trying to tell us. And I don't react out of anger because I'm always open to take the trades that they come. So that's where I'm going to end it. I want to thank David for contacting me. I want to thank David for just really being a great guy and not getting all upset when I said, oh my God, you know, had a senior moment there, David. So, and I wish everybody a really great trading week. And again, thank you very much. And we'll catch you next time around.
No problem. Thank you, Michael.
You're welcome.
All right. Thanks, everyone.